All right, we're going to officially start the second half of the course today. And up until this point, we've been doing the accounting for a service type company. So that's a company that provides a service like what have we done? We've like dentists, we've done golfing schools, we've done driving schools. So all those companies provide a service as opposed to a product. So today we're going to discuss a merchandising company, and that's a company that provides a product as opposed to a service. So we're talking about wholesalers and retailers. Now, a merchandising company differs from a manufacturing company because a manufacturing company actually makes the products. A merchandising company sells products. So they buy from the manufacturers and then they sell the products themselves. Now that the goods that a retailer and a wholesaler buys from manufacturing company is called merchandise. Now when we calculate the net income for a merchandising company, it's slightly different than for a service type company. And it's different because our income statement is going to have another major section, and that major section is called the cost of the goods sold. And since the cost of goods a merchandising company sells is so great, it has its own section on an income statement. Okay, so what we're going to find is we're going to have a revenue section, a cost of goods sold section, and an expense section. So three major sections. And revenue minus cost of goods sold will give us gross profit. And then gross profit minus the expenses will give us a net income or net loss. Okay? So why do we now include cost of goods sold on our income statements to determine net income or net loss? And the reason is because a merchandising company has to pay for the goods that it sells. So we're going to have a net income when our revenue is greater than the cost of the goods we're selling and the expenses combined. Okay? So when the revenue is greater than those two things combined, we're going to have a net income. We're going to have a net loss if the revenue is less than those two things combined. Okay? Now, we're going to look at an example of a income statement for a merchandising company. So you'll notice that it has a revenue section, it has a cost of goods sold section, and it has an expense section. Now, the revenue section will have our sales, and then we'll have contra accounts to sales, and we'll discuss those later, and then ultimately we'll get a net sales figure. So net sales minus cost of goods sold, and this is the cost of goods sold section, and we'll discuss that in a second. Okay, so revenue or net sales minus cost of goods sold gives us gross profit. Okay, because hopefully you're selling your goods for more than what you're paying for them. Okay, and then the gross profit minus the total expenses will give you your net income or net loss. Okay, now to simplify the cost of goods sold section on an income statement, okay, we can prepare what's called a schedule of cost of goods sold. Okay, now all it is the cost of goods sold section on a separate piece of paper. It's similar to our schedule of owner's equity. Remember, if we completed a schedule of owner's equity on a separate piece of paper, then our owner's equity section on our balance sheet was only one line long. Okay, now why do we sometimes prepare a schedule of cost of goods sold? Okay, the schedule will provide in detail how the cost of goods sold figure was determined. Okay, because we're going to have to start worrying about all other costs related to purchasing the merchandise. So we're going to have to add transportation costs. We're going to have to subtract discounts. We're going to have to subtract any returns we make. So let's take a look at one. Okay. So here is a schedule of cost of goods sold. So you'll notice we'll start with a beginning merchandise inventory figure. And we're going to leave that for a second. And we're going to write down any purchases we made over that fiscal period. So in this case, 50,300. Then we're going to subtract the two contra purchase accounts, purchase returns and allowances. So anything we returned and any discounts we received for paying quickly or for whatever reason we got those discounts. So those two discounts in total amounted to 5,100. So purchases minus the two contra purchase accounts gives us net purchases. Okay, so in this case 45,200. Then what we're going to do is we're going to add any costs related to getting the goods from the manufacturer to us. So in this case it was $1,100. So net purchases plus the transportation in gives us the total cost of the goods purchased. Okay. Now we're going to add total cost of goods purchased to our beginning inventory amount. Okay, and that's going to give us total cost of goods available for sale. So this plus this, total cost of goods available for sale. And then we're going to subtract what we have in ending inventory, which is $20,100. Okay, so that's going to give us cost of goods sold. Now this figure will show up on our income statement, right? So when we complete the income statement, okay, oops, not this one. You'll notice that the cost of goods sold section is only one line. So $46,200. Okay, so our revenue, our net sales, okay, minus our cost of goods sold gives us a gross profit of $49,400, and then minus our expenses gives us a net income of $34,200. All right, I'm going to stop, or actually this is what we just went through. Okay, so the basic formula for cost of goods sold is beginning inventory plus the purchases minus the ending inventory, so cost of goods sold. But there's a problem. What if we return some stuff, right? So what we have to do is we have to subtract anything we return, okay? So we record returns to the manufacturer in an account called purchase returns and allowances. So that's going to have a credit balance, and it affects the cost of goods sold. So similarly, if we get a discount off the invoice price, it also has to be recorded because it affects the cost of the goods that we're going to be selling. So that's going to be recorded in an account called purchase discounts. So that's another contra purchase account. It's going to have a credit balance. So purchases minus purchase returns and allowances and minus purchase discounts will give us net purchases, just like what I showed you on the schedule of cost of goods sold. Okay, and we also have to worry about transportation in. So the transportation charges to get the goods from the manufacturer to the retailer has to be also accounted for, because the transportation costs increase the cost of the goods that we're selling, right? We have to pay for getting the goods to us. So transportation costs are added to net purchases to get total cost of goods purchased. Okay? Now, remember, the merchandise inventory account, all it is it contains the value of all the goods on hand to resell. And the schedule of cost of goods sold is going to have a beginning inventory figure as well as an ending inventory account figure. So I'm going to stop there, and I'm going to do the last two pages on another video.